Uh, so having, I don't think that I did anything about working capital last week, no?
No, sir.
Okay, right. Let's focus on working capital finance today. Generally, the bankers are not going into working capital management, rather working capital financing, because the working capital management is done by the entrepreneur himself. So our focus is working capital finance. Now, first of all, we should be able to understand what is working capital. And then there are very important concepts that we need to understand in this one. Supposing if non-bank or other bankers who are not into credit might struggle to understand some of the areas, in that case, best thing is to stop me and ask questions so that I will come down to the level that you understand. Some people may understand, some people may not understand. Please interrupt me and ask questions, because I can't sense your faces, I can't really see the responses unless you speak out. So I'm in a very pathetic condition, because since I don't see all. However much that I tell the IBSL, they don't start the physical classes. So this type of explanation cannot be done over a digital device. But having said that, only I'm doing this one. Okay. If you feel very uncomfortable about the explanation or the workings that we are going to do today, please stop me and ask. The working capital refers to the part of the capital, in the sense basically fixed capital and the working capital, and it all in the asset column. Okay. And in the asset column, there are two areas, fixed assets and the current assets. So the discussion basically focus on the current assets. In the current assets column that you see, generally the inventories are there, debtors are there, cash are there. There are many other things, but then again, the basic stuff is that. Basic three categories are the inventories, debtors, and the cash. And the inventory is a general term which it comprises basically three formations, like raw material, work in progress, finished goods. Okay. And then if you get a very extended version of a company like a manufacturing organization, obviously they need to procure raw materials. So the raw material will be there for a period of time, and then that will be pushed in the factory. So that you call the work in progress, because what happens is that I'll show you what happens in the company. Can you all see the ink?
Not very clear.
Is it all right now?
Yes, sir.
Okay. I have two statements over here, the P&L and the balance sheet. In the balance sheet, you find fixed assets and the current assets. Current assets basically has got three apart components: stocks, debtors, and cash. Stocks, there are basically over here too, raw material, and every time the raw material are pushed into the production flow, there you find work in progress, and back here finished goods. Okay, though the work progress over here that we assume this is over here, so this part of the uh, this part of the balance sheet is called as gross working capital. Okay, and then this is the management side of it. How best that they will manage along with the finance part of it. If you take this whole box over here, that has to be financed by 1-to-1. 1-to-1. So this is called gross working capital. And if you fund this 1-to-1, so ideally, initially what happens is the owner will have to fund this one, equity. Provided that there is nobody to support him. The owner will have to bring the entire quantum of money and put in there. So that's equity, 1-to-1. So in this case, you can see net working capital. Net working capital is equivalent to current assets minus current liabilities. Okay. So here the current assets will, let's say 100 minus how much is the current liabilities? How much is the current liabilities?
Zero.
Zero. So answer is 100. So the entire net working capital has been funded by the shareholder. That's the most ideal situation for a banker to see, of course, because risk, very low risk. But it doesn't happen all the time. So the shareholder would like to fund only part of it. Let's say like this. Then you can take this line off, assuming that this is 100, this is 80. 80 represent the current liabilities, I would say, which has got two parts: bank advances and supply creditors. Let's say that part is 60. So now you have answer current liability is 60. Then the answer is 40. That means the shareholder has funded 40. So the net working assets or a net working capital rather is 40. The net working capital has been funded by the shareholder. But in most of the cases, shareholder won't do that. They will come and tell the bankers, I need this money. So that the banker will fund this part as well. So this becomes either equity or bank loans. So what you need to understand is permanent working capital requirement is funded either by the shareholder or by bank loans. What is this permanent working capital requirement? The working capital requirement which is not been revolved. That means if you take 100 over here, is remain at every given point. It doesn't mean 100, because of 100 the sales are also equal to that. No, sales are more. Let's go here. Hypothetically, let's say sales are 1000. Cost of sales are 800. Then you have 1000, 1000 and 200 is the gross profit. Okay, 200 is the gross profit. In this cost of sales, there are three elements: opening stock minus plus purchases during the year minus closing stock. So if you get a P&L and a balance sheet at a point, of course, let's say out of this 100, 40 is the inventory. That 40 is reflected over here. Okay. Let's say the sales are 1000, but all these sales are not on credit basis or not on cash basis. Part of that may be on credit basis. So that component is reflected over here. Okay. Otherwise, what happens is every time the cash component should have been gone up, risen up, if he does everything on cash basis. So that's the basic combination. Don't be confused about what I said right now if you are confused, but try to understand the relationship between the balance sheet and the P&L. And also that you need to go further down and understand the relationship between P&L, balance sheet and the cash flow. So this is just a kind of a eye-opener to go into my presentation. So what you need to understand is these column, this set of assets are called as gross working capital. Current assets minus current liabilities is called as the current net working capital. But the bankers will never fund net working capital. Write it down somewhere. Bankers do not fund the net working capital. Bankers do not fund the net working capital. So at the same token that there should be a question from your side. Then what do the bankers finance? Bankers do finance net working capital requirement. Net working capital requirement or net working assets. Net working capital requirement or net working assets. Net working assets. Or net working capital requirement. How do we determine that? You need to know the average stocks that are required by an organization to run. Average required stocks need to be there in the business at any given point, plus average debtors minus average creditors. Now, if you take a balance sheet at any given point, you could see what is remaining in the balance sheet is the average numbers. So if you take a balance sheet on the 31st January, you have some numbers over here. You take a balance sheet on 28th February. You have some numbers here. Likewise, you take balance sheets of each and every day. So when you take these respective numbers, you get a number over an year, because you need to get the summation of all these numbers and divide it by 365. You get a number. That number is here. That is what we call the average number. So it doesn't mean that there is one exact permanent number over there. No, it is an average. You need to remember that, otherwise you will be confused in time to come. How can a person determine exactly the average numbers over here? I will show you the theoretical aspect. You know that we studied equation called stock retention period is equivalent to average stock divided by cost of sales into 365. So if someone wants to know exactly the average stocks, either he should know a couple of things. Now the answer is here, average stock. To know that, he should know the stock retention period. How many days worth of stocks? Days. How many days worth of stocks that have been required? Days, number of days. Of 365. That is known. And the annual consumption of raw material. How do you determine this number? Opening stock plus purchases minus closing stock. So this is the annual consumption. Many people don't understand this concept. They say, "Nikan girav wage hamadam kiyana palita kiyaගෙන යනවා cost of sales කියලා." But what do you mean by cost of sales for this particular purpose? Annual consumption. So if someone wants to know the daily consumption, what they have to do is, I'll put it other way around. Daily consumption, cost of sales divided by, to know the daily consumption, can someone give me the answer? Annual consumption is given. To know the daily consumption, what you need to do? That number should be divided by
365.
365 into, if someone knows the retention period, multiply by the stock retention period. So you get average stock. Same equation, I put it in a different format. If you don't master this concept, it is very difficult to understand what is working capital financing. Any questions? So similarly, you can develop for this as well. Let's try to do it. Debtors retention period is equivalent to average debtors divided by, come on, divided by
365.
No. I do refer to this. Average debtors cannot be divided by 365. Average debtors need to be divided by
Sales.
credit sales into 365. So you convert the ratio into the other format. Now what you need to know is average debtors. If someone wants to know the average debtors, so he has to look at the annual credit sales. Credit sales, when you say credit sales, that is annual credit sales divided by, now divided by
365.
365, good, into debtors retention period. Let's go to this. Creditors retention period is equivalent to average creditors divided by credit purchases into 365. Now your question is, how much is the average creditors? Is equivalent to credit purchases, annual credit purchases, by the way, same thing, divided by, to know the daily average, daily credit purchases, divided by 365 into credit, what do you call, creditors retention period. Hope that you understand what I said. Okay, I'll repeat that again. The bankers won't fund the net current assets. So net current assets, basically current assets minus current liabilities. Net working capital rather, net current assets, so net working capital. Bankers do fund net working assets or net working capital requirement. To know that, you should know the average stocks, average debtors minus average creditors. So this is what we are trying to do with the case studies. Can I erase the board right now? Oh, let me go to the presentation and come back here. If you take the working capital, there are two basic concepts. One is the basis of concept, the other one is the basis of time. If you take the basis of concept, you can see gross working capital and net working capital, which I discussed already. Gross working capital is a summation of current assets. Net working capital is current assets minus current liabilities. Okay, what we really required is a basis of time. What is permanent working capital, or rather fixed working capital? What is temporary working capital? And what is seasonal and special working capital? Gross working capital is understood. The working capital required by a firm to have to run the business. It says it should be neither excessive or not inadequate, because the thing is, you have to make the customer should maintain appropriate level of current assets, because if it is below the average, then he will be losing. Above the average, then he will be losing. In the sense, if they have excessive amount of current assets, like in excessive amount of stocks, more than the requirement, excessive amount of debtors, excessive amount of cash, then he is losing, because it is not the prudent way to manage current assets. Vice versa, if there is a shortage of current assets, shortage of stock, shortage of rather cash, then he will have to source them at a high cost, so that he is losing. So it is up to the company to maintain the appropriate level of gross working capital. It is the duty of the banker as well to ensure the customer is maintaining such a appropriate level. Otherwise, what happens is every time the customer used to come to the bank and ask for more and more money. Asking more and more money is not going to solve the problem unless the customer ensure the efficiency of managing working capital. Efficiency of managing working capital, that is also going to be answered in our case study. Okay, so this is accounting definition. Remember, net working capital is the accounting definition, current assets minus current liabilities. That is very closely related to current ratio, where we take the current assets divided by current liabilities so that you get a ratio. Generally, we see the current ratio has to be an acceptable level of at least 1.5 times or 2 times. That means if you take 2 times for an amount of current liabilities, let's say 50, the company should have current assets of 100. That's a good thing because that determines the liquidity of the company. Liquidity of the company, because 50 is funded by permanent working capital, which doesn't have to pay immediately. You can take time to pay that 50, or rather it is funded by the equity. You don't have to pay at all. If it is a loan funded by a bank, of course it takes time, like 3 years or 5 years. Generally the working capital loans are extended for 3 years even. The golden question that I need to ask and you need to remember is, what do bank finance? Net working assets, stocks plus debtors and creditors, which I explained very thoroughly. So this is the area that the bankers will fund. But before that, let me explain this concept: permanent working capital and the temporary working capital. So now I'm going to erase the board. To run, as I told you earlier, to run a working company, first of all, you need to calculate the working capital requirement. Okay, working capital requirement. Typically, that I will take an example and try to calculate it. But to understand the concept, working capital requirement is over here average stocks, average debtors, and then minus average creditors. I'll repeat that again. So you need to know average stocks required by a company to run the organization for a period of 1 year. Average debtors should be, if they are at any given point, average creditors. Someone wants, of course, you can use the average cash as well. Okay. So let's, for the clarification, we'll take only these three. So the working capital requirement is this. Any questions so far? Okay, working capital requirement is that. So that component is taken over here. Now this is months. Over a period of 1 year, they need this much of working capital requirement. If you see the behavior of this average working capital requirement, you can see an equation. You can plot this. If you take every day's balance sheets of net current assets, you can see a diagram like this. I don't know whether you can see the board or not. So you take the minimal point over here, the lowest point over here, and draw up a line. That's called the fixed working capital requirement. හැමදාම ඒ වාහන හැම දිනයකම අවම වශයෙන් ඒ ගන්න තියෙනවා. මේ දවසේ මෙතන තිබිලා තියෙනවා. ඊට කලින් ඊට උඩින් තිබිලා තියෙනවා. Make that's the basis, or that's the buffer which cannot go down more than that. Or it has to be more than that. Now this is the average නේ. ඒකින්ද මෙතෙන්ටම ගහන එක වැරදි. මේ ඩොට් එක පල්ලෙහාට ආවට මේක දවස් කීපයයි නැවිලා තියෙන්නේ. ඒ හින්දා මේ ඉර ගහන්න ඕනේ මෙන්න මේ හරිය. Okay, I'll read on this. I'm sorry. This is how it goes. Okay, not only that, I'm sorry. Let's go like that. Something like that. That's the behavior of every day. So there's a component which we call revolving working capital. Revolving working capital, I have drawn up a line over here. So this is the permanent level of revolving working capital requirement. Permanent level of revolving working capital. So what we can do is, you have to draw up a line over here. So you have a limit. Let's say this one is 5 million. This one is 10 million. For this 5 million, you have to come up with a working capital loan, or else it has to be funded by the shareholder, whatever it is. If you agree with, of course, you will fund 5 million, hypothetical. And the rest is about, let's say, 10 million. We will try to work out this one. So within the context of 10 million, you can see the behavior in line, but there are events where it has gone over and above the general working capital requirement. That's called the seasonal working capital requirement. Okay, this is the permanent level of working capital requirement. So this goes, for which you have to work out cash credit facilities, or overdraft. For this column, you need to facilitate either cash credit or overdraft. The other day I explained what is cash credit. STLs, trust receipts, bill discounting, bill purchase, bill negotiation, pledges, factoring, things like that. How do we determine this one, whether it is cash credit or working overdraft? It all depends on the cash cycle. Is equivalent to days stocks plus days debtors minus days creditors. If the cash cycle is so efficient, for an example, less than 30 days, you would prefer to give him overdraft, that corridor, 10 million. If the cash cycle is very lengthy, like 120 days, you should give him cash credit facilities, because it is more like this. Ideally, you should try to discourage the overdraft facilities, because we develop a corridor and let him go as he wish. But cash credit facilities are under control by the banker. So now I can go to a case study. Would you like to ask some questions before I go to the case study? Oh, totally confused. See that I don't see your paces to get the responses, and you don't talk to me, though that I'm really in a very pathetic condition. Okay, let's go to the case study. Number 1. Have you got the case study in your hand? Because I need the board.
Yes, sir.
Number 1. How much working capital does a company need as it grows? See, if you all are branch managers, this is the basic set of questions that have been asked by the entrepreneurs every time they walk into the bank. How much does a company need as it grows? Remember, this is not developed by me. This is an international case study. An Australian gentleman has developed this case study. This is a very, very strong case study. Okay, read it. CFO, Chief Financial Officer, reports that sales in the last year were 53.25 million. And the account policies reveals days accounts receivable basically about 63 days. That is the debtors receivable dates. And then stock retention period is 57 days. Stock credit, creditors retention period is 51 days. They take 51 days to pay the suppliers. They collect the money from the debtors within 63 days. And also they need about 57 days to have stocks, in the sense that they need 57 days worth of stocks to run the business. They need 63 days worth of debtors to run the business. Every time when you look at the balance sheet, of course, an average, as an average, of course, 63 days worth of debtors are stuck. And also they enjoy a comfort of 51 days worth of suppliers' money, and they don't pay it at any given point. Because in the balance sheet, you don't see the number of days, you see the average balances. Average balances, in the sense the value of the average balance is determined in terms of the number of days. The company's net operating cash margin is 4.5%. In the sense, if they buy something at 100, they will sell at 104.5%. The company is budgeting to increase its sales by 25.3 next year. Right now, it is 53.5. So what is the next year sales going to be? Can someone tell me? For the last year, he says, he come and tell you, last year I had a sales volume of 53.25 million. Next year, I'm going to increase my sales by 20.53%. How much is the budgeted sales?
66.72.
Exactly. And the bank charges the company at 8% for working capital funding. If the bank is going to give away working capital financing, they will charge about 8%. Okay. The question number 1 is the basic question. How much company funds are currently tied up in working capital? That means they have not borrowed a single cent right at this moment. And the question asks you, right at this moment, how much of company cash is tied in working capital? Because this is a going concern. This is a going concern. Okay. Now what you need to do is you need to develop the current balance sheet in terms of working capital. So you have to understand exactly the question, how much company funds are currently tied up, in the sense the net working assets නැත්නම් net working capital requirement එක හදන්න කියලා තමයි මේ කියන්නේ. මේ මොකක්ද question එකකින් කියන්නේ net working capital requirement එක හදන්න කියලා. Net working capital requirement එක හදන්න නම් you should know the average stocks, average debtors minus average creditors. ඔය තුන හදන්න ඕනේ. මොන තුනද? Average stocks හදන්න ඕනේ, average debtors හදන්න ඕනේ, average creditors හදන්න ඕනේ. හරිනේ? Hadamu, you go with me. If you have any questions, please stop me. I know in the class only there are 2 people. Though there are locked about 38 people, I don't know whether they are working with me or working with the wife and spouses or children. That is what happens now every time. Anyway, in your class about 120 people are there, but 38 people with me have logged in. That is the beauty of participation. Okay, never mind. I will do the justice for the people who are connected with me. Okay, the last year sales were 53.25 million. By the way, if you do have friends, tell them that I am not going to share the videos. That is my policy. None of these videos will be available on the IBSL website. If they are going to share with you, of course, I will quit from IBSL. Okay, now you need to know the cost of sales. Okay, the first question before that, why we need to know the cost of sales? Because now this is the balance sheet that you are going to develop. You should know the average stocks, average debtors, average creditors. And the question asks you, what is this amount? Clear? What is that amount? So the first question is, how much is the average stocks? Last year sales were 53.25 million. Huh? And then the first question what we are trying to ask is, now we know by equation right now, if you want to know the average stocks is equivalent to cost of sales divided by 365 into stock retention period. Now you know 365 is given, stock retention period is 57, but you don't know what is cost of sales. How do you know the cost of sales? They give you information. They say last year it was 53.25. Their policy is 104.5%. Then what is 100? 53.25 divided by 104.5% into 100. This is not the GP margin. This is margin on cost. This is not the GP margin. This is margin on cost. What is the answer? Am I right? 55.95?
Yes.
Right. Now you can apply 50.95 over here. So stocks. $1.9. 7.95. Similarly, you can know the debtors. Average debtors is equal to.
Excuse me.
Yes.
How can we compute that net operating cash flow margin, sir?
Okay. For an example, if you get 120 million sales, cost of sales 80 million, GP is 40 million. Okay. Now, if you calculate the GP margin, is how much? 40 divided by 120 into 100. What is the answer? $33.33. But actually, this fellow, okay, this fellow has got 40 million out of 80, no? Isn't it? Make a loke puram dina prashnayak ne. So this is called margin on cost. This is called gross margin. So what the question has given you is 50%, not 33.3%. Are you all right?
Yes, sir.
Okay.
Margin of cost. Margin of loss.
Next one, debtors. Average debtors is equivalent to credit sales divided by 365 into debtors retention period. Now I have an argument over here. Ideally, you should take credit sales. For the purpose of reconciliation, for you all to understand very clearly what I am doing is, I will take cost of sales. Then you will be confused. Therefore, I will take both. Okay. If I take cost of sales, 50.95 divided by 365 into 63. If you take sales, we also make an assumption over here. We have not given any information about whether the entire sales are on credit basis or not. From the given information, we will assume entire sales are on credit basis. One answer is 8.79. The other answer is 9.31. So what happens is, in this context that we are not going to see the efficiency of the organization. Our purpose of calculation is working capital requirement. Basically, I don't want to fund him for a, because this answer is in a way wrong. Why it is in a way wrong? Because 9.3 is with the profit margin. So the banker doesn't need to fund his profit margin. That's the presumption. But therefore, I would prefer to take 8.79 rather 9.3 in up one. But whatever it is, what my humble advice is all the way, all the time, you try to work out the working capital requirement, okay, and decide what is the basis. Almost all the bankers are taking credit sales, not the cost of sales. Remember that, okay? But for my reconciliation purpose, I will go by the cost of sales. Any confusion? Now you need to work out creditors. Creditors, again the ratio you know. So we will take cost of sales here, 50.95 divided by 365 into.
Sir, excuse me.
Yes.
Can you please explain again why you take cost of sales instead of credit sales?
Okay. Now this 8.79 is without profits of the customer. 9.31 is with the profit margin. This exercise is for the purpose of working capital financing. Earlier on, we used to calculate to know the efficiency of the company. So in that case, of course, you obviously need to take credit sales, not the cost of sales. But in this exercise, what we are trying to see is, we are trying to fund his working capital requirement, the money. The question asks you, how much money, how much company funds are currently tied up in working capital? His profit is not currently tied up. It has to come after sales. That's the argument. But in the practice, what happens is all bankers are taking not the cost of sales, but the credit sales. You take credit sales, no problem. But you should know the fundamental and do it. It's almost like playing a hook shot or a deal scoop. Deal scoop is not in the book. What is in the book? Orthodox cricket. Why you hammer deal scoop? Because to take the advantage. Likewise, of course, in the application, you can do whatever you want, but right at this moment, try to understand the concept and do whatever you want. Okay?
Okay, sir.
Okay. Is the board clear?
Yes, sir. And
Okay.
another thing, so how do we know to get the cost of, I mean, it's, for example, if it is in exam, how do we know whether to take the cost of sales or the credit sales?
Examiner will accept both. Make a note. Your calculation is based on cost of sales or credit sales. That's it.
Right. Thank you, sir.
Okay.
Excuse me, sir.
Yes.
Uh, I am working at PFC Bank, and in our working capital calculation model, they have the percentage of credit sales. How to affect the percentage of credit sales to the working capital requirement?
I didn't get your question.
In our working capital requirement model in the bank,
Yes.
they have mentioned the credit percentage of credit sales. So how to affect the percentage of credit sales to the working capital requirement?
Have you got the second case study in your hand? So this is the basic case study. The second case study is going to be somewhat difficult with the percentages. In that, of course, it says 70% on credit sales, 60% on credit purchases. We will do at that time.
Okay, sir.
Okay. It's too early now. What is the answer over here? $7.11. So my basic question is, this is what you need to understand. Is it the number? Is it 9.63 or the 10.15 which has been stuck in the company funds? Ideally, it is 9.63, but one can argue that some of the money which should have been invested, like part of the profit also. Yeah, I agree. Don't worry. Try to understand the concept, and later you can apply the way that you want. And also, you can work out the working capital cycle. Working capital cycle. 57 days, 63, altogether 120, but they get a comfort of 51 days. So the working capital cycle is 69 days.
Excuse me, sir.
Yes.
Can you please explain again how did you arrive at that creditors retention period?
Creditors,
Retention period.
retention period is given 51.
Okay, sir.
It's in the case study. First question is answered. How much the company funds are currently tied up in working capital is 9.63. Next one. If the company is going to achieve the budgeted level, but nothing changes, in the sense these policies will not be changed, working capital cycle will not be changed. How much extra working capital will be needed in the next year? This is the basic question that everybody asks. No, they come to the bank and ask for working capital. My business is growing. Why don't you give me additional working capital? Now this is what you need to do. Okay. So as we explained earlier on, now the sales are not 53.25. It is 66.72. Given that, how much is the cost of sales? How much? Here. Here. 63.84. Now you need to know the budgeted average stocks. Budgeted average stocks. So you have the cost of sales 63.84 divided by 365 into 57 days. 9.96 million, by the way. Then you should know the average debtors budgeted. I will go by the cost of sales 63.84, which is the cost of sales, new cost of sales, divided by 365 into 63 days. So they need in next year 63 days worth of debtors to run the business. $11.01. Your gross expected or projected gross working capital is 20,000,097, 20,970,000. But still they will get a comfort from the suppliers, that is 51 days. $8.92. Now the new working capital requirement is 12.05. But the question asks you, how much is the additional working capital requirement? How much is the additional working capital requirement? Can someone tell me?
$1.90.
No.
2.42.
2.42. Because out of 12.05, already the customer has invested 9.63. That is customers. So additional working capital requirement for the next year is going to be 2.42 million, 2,420,000. 2,420,000. Third question. How much will the extra working capital funding cost the company? But before that, you need to decide what is the facility that you are going to give away. There is a question, no? How much working? No, it's not there. What is the facility? Is it a cash credit permanent? Okay. I told you there are three types of facilities that can be granted on working capital. Number one, permanent working capital loan. Number two, cash credit. That means STL, pledges, trust receipt stuff. Number three, overdraft. Theoretically, tell me the answer. What is the facility that you are going to support in? Is it the working capital loan, cash credit, or overdraft?
Or
What is the basis?
funding to increase of working capital requirement,
Now we discussed about
increasement
the
of
basis.
working capital.
No, now the critical point is this cash cycle. Whether the cash cycle is so efficient or not. Obviously, I do agree with you because this is a little amount, 2.42 million can. But theoretically, if the working capital cycle is less than 30 days, of course, you could think of an overdraft. But here it is 69. For him, I would prefer to give him cash credit facilities, either STL or trust receipt, whatever, depending on the nature of the stocks and the nature of the transactions. 2.4 million or 3 million even, I don't mind. 3 million, I don't mind. STL facility, not 69 exactly, even 90 days, I don't mind. So then he is comfortable. Remember, these are average numbers, but we have arrived at our average numbers. It's not exactly the same number. So that I don't mind making him 3 million for 90 days, not 60 days. 60 days is short. 90 days, 3 million STL facility. Let's say he is given 3 million. And he utilized max for the entire year. What is the cost? For him. Work it out. I will take 2 minutes break until such time. 2 minutes. Hello. Assuming that 3 million is going to be giveaway and also it is being consumed packed over a period of 1 year, what is the interest cost for the company?
240,000.
2,40,000, right. Next question, what can the company do about this funding cost other than by reducing the sales? The question asks you, how can they eliminate this 240,000 but without compromising the sales? That means they should not borrow from bank. So this is nothing to do with working capital financing, but to do with working capital management. Can the company manage working capital without resorting to bank financing? In that context, they need to work out the working capital cycle. This is yet another problem that the bankers don't understand. Every time when the customer comes and asks, money, I am stuck, what does that mean? He is not managing his working capital or other working capital cycle. So you have to advise him to manage your working capital cycle, but not in this case, of course. This case we have not properly funded, no, so that you have a room. So what is the answer? Answer lies on this particular column, working capital cycle. What do you suggest? This is the most difficult question if you don't understand the question. Any idea? Okay, I will give you a clue. This number should be changed. 69 should be changed to another number. What is the number? I'll show you something. Now in this case, rather than calculating all this stuff, you can take this 9.63 like this. How? 50 million, 9.5 is the total consumption. Purchases. 50.9 million, 9.5 million is the total consumption for annual. Per day consumption, you need to divide it by 365 into. To run this business, this is why I took cost of sales for each and every item. To run this business, he needs how many days worth of stocks? How many days worth of working capital? He needs how many days worth of working capital? I'm asking from 1 or 2 people in the class. Others are not there. A young lady and 2 boys, I believe. How many days worth of working capital? Not stocks, not debtors, not creditors. How many days worth of working capital they require? No answer?
69.
Exactly. So the answer is 59 point divided by 365 into 69. So 9.63, the same answer. So right now 63.84 divided by 365 into 69 again, you will get the answer like 12.05. Now what you need to do is, you can't compromise 63.84 divided by 365. The question asks you, what is this number? It's not 69. Then what? Guess and tell me. It is not the exact number, but someone closer. So it is not 12.05 what you need to achieve. Rather, you should achieve something else. So what you need to do is, in simple terms, instead of this 12.05, you should get same answer over here, 9.63. To get 9.63, you need to adjust this number. In the sense, you have to adjust these numbers and these numbers. Because this is what the customer has right now, 9.63. So will you get 9.63? Okay, what is the number?
55 days.
65.
60? You say
55.
sorry?
55.
55.
63.84 divided by 365 into 55. Then you get 9.61. Excellent. Excellent answer. So that is the answer, right, by the way. So now you have a new norm. What is the new norm? I have the bottom answer, that is 55. Then you should advise the customer to pragmatically change the numbers over here. That is a deduction of how much? 14, no? 14 days reduction. That's not an easy task. So probably he may have to come up with 52 and 60, 112, 112 divided by minus by 55, 57. That's bad. Let's say 50 over here. Or rather, we'll go like this, 52, 60. Here again 65. 5, 7. Whatever it is, I don't get a number. It's a very simple thing. You have to adjust. You know that permutation and combinations are there. You have to work out the numbers. Of course, with the concurrence of the customer, which has to be equivalent to 55 because 63.84 divided by 365 into 55 will get you something like 9.61. So adjust these numbers. That is called working capital management. Any questions from there? Any questions? Can I go to the next case study and have a break thereafter? Or we'll have a break right now? Or what do you prefer? Okay, let's go to the next case study. Case number 1, number 2. If there are no questions from this one. Second case study says monthly sales 12 million. So how much is the annual sales? $144 million. Now try to work out the cost of sales. $144 divided by 130 into 100. $110.76. Then we have to work out the stocks. Stock period is 30 days. Very simple. 110.76 divided by 365 into 30. 9.10. Debtors, they say 45 days. But this 45, we will go by the cost of sales, by the way. Out of 110.76 into 70% divided by 365 into 45 days. Or you have another option. This 45 days worth of 70%. 45 into 70%. That means 31.5 days. Or you can say 110.76 divided by 365 into 31.5 days. You can work out in both ways. 9.55. In both cases, you should get the same answer. Then you have the working capital, what do you call, gross working capital, 18.65. You have a cash cycle 575 days. In this, the value of the cash flow 61.5 days, not 75 days worth. Then go to the creditors. Creditors, same principles. $110.76 into 60% divided by 365 into 20 days. Or 110.76 divided by 365 into 70 of 60, sorry, 20 of 60, 12 days. Both cases you should get the same answer. $3.64. If someone wants, you can reconcile this one. Now, annually they need about 110.76 worth of money, goods to the company, divided by 365, multiplied by, not by 55 days, 49.5 days. So you get the same answer, 15.02, the answer. Conceptually, what you need to understand is this. Stocks, debtors. Their stock requirement is 31.5 days worth of stocks. For a period of 30 days worth of stocks for a period of 30 days. Debtors, 31.5 days worth of stocks for a period of 45 days. Don't confuse, the rest is cash. But there is somebody who is supporting over here for a period of 20 days, creditors, but the value of the creditors is 12 days. They support for a period of 20 days, here 30, here 45. But you need to understand the difference between period and the value period and the time period. So we have done the working capital requirement that comes to 15.01. Suggest a credit package. The total working capital requirement is 15.01. Ideally, you should discuss with the customer and ask him to contribute at least 25%. So that is permanent working capital. Or if the customer doesn't want to fund any single cent, you can decide. Ideally, you can come up with 25% as permanent working capital. But to decide whether it is a working overdraft or a short-term loan, ideally it has to be a short-term loan or trust visit or a cash credit facility, because the length of the cycle is more than the 30 days. The length of the cycle is 55 days. The value of the cycle is 49.5 days. Okay. So I would say 25% as permanent working capital, the rest is revolving out of 15.01. I would come up with 10 million as revolving working capital. 10 million STL for 60 days. 5 million working capital loan for 3 years. 15 million. That is enough. Next question. If the customer imports material under document to credit site where the lead time is 30 days, rework the credit package. Let's have a break and come back. Any questions so far? I need energy to do the rest. Any questions? Yes. Tell me.
Sir,
Yes.
how did you break that working capital into 10 and 5, two facilities? What is the concept?
Ideally, you should take maximum. Did I make a mistake? Yes. Sorry. It has to be maximum like 4 million, 3.75. 11 million would be STL. 3.75 is the answer. Basically, no. Sorry. Generally, to demarcate between permanent working capital and the revolving working capital, ideally, you have to look at the nature of the business. Okay. Now, supposing if everything is imported over here, 110.76, we can work out 100% revolving for which, then STL would be 15 million. The next option, ideally he also should contribute to a certain extent. Then discuss with him and ask him to contribute certain amount of money, and then you can reduce the facility accordingly. The next option is permanent versus revolving. There is a norm 40-60, like 40% permanent, 60% revolving. In that case, 50%, 40% in the sense out of 15, 6 million. So 9 million would be the ICA. So these are options only, by the way, not theoretically understood or accepted norms. 40-60 is just a norm only, but nobody knows exactly whether it's accurate or not. It all depends on the relationship, the nature of the transactions, and negotiations. And if you also can fund 100% STLs, 15.01, provided that you have a control over them. And the permanent nature ideally should have been funded by the shareholders, equity. They won't like it. They won't like it provided that they have funded for every other thing. Then they will ask, no, working capital has to be funded from the bank. No matter what it is, of course. You need to decide. It's a credit decision. There is no way that in the world, of course, how to exactly determine amount of permanent working capital. Now, what all you do is bullshit. Nowadays, there are credit lines coming from Saubhagya and everywhere. Of course, it is just a simple calculation about permanent working capital. You have to fund loan it is permanent working capital, not the revolving working capital. Revolving lines are different. No, import line, export lines, packing credit. All these are revolving line. For working capital, it is not the working capital loan. That මෙහෙම ගත්තොත් එම grocery එකක් නම් hardware එකක් නම් you can't provide them STL. So basically what you do is you give them working capital loans. That's okay because you can't exactly know what purpose STL කියලා එහෙම කරන්න බෑ. Garment එකක් නම් yes. Project එකක් නම් yes. You can work out the working capital lines. But for a grocery, even for a filling station, hardware, where the cycles are not properly determined, go by the permanent working capital loans. STLs are not appropriate in that context. STL would be appropriate only provided that you can look at the consignment independent, then you can work out the working capital STL. Or a seasonal like pledges, it's very, very simple. During the Yala season, Maha season, you extend them pledge loans or trust receipts to buy the paddy, X amount of money for a period of 6 months. Very simple. And you don't have to struggle to work out this working capital. But once you know exactly the working capital calculation, it is very easy to get away from there and do the extensions. Very easy. But every time try to look at the working capital requirement. So within the context of working capital requirement, it is up to you to decide exactly whether it is revolving or permanent or cash credit or overdraft. Even though I say below 30, it has to be overdraft, not necessarily that you should decide like that. It is a very good question. Shall we have a break and come back?
Yes, sir.
Okay. Hello. Before I go to the next part of the question, let me discuss how bankers do structure credit facilities, especially working capital facilities. So let me run through the slide presentation. Hope that you can see the slides. Yes?
Not yet, sir.
Not yet. Okay.
Now, okay, sir.
Okay. Now you can see out of the working gross working capital, the bank funds, the bank finance is coming in terms of bank advances and loans. Loans are ideally for permanent requirement. How the working capital improves or decrease? A working capital position can be developed or risen as a result of couple of things. Long-term sources are used to fund current assets. The long-term sources are the summation of equity and debts. If the debts and the equity is more than the fixed assets, that means part of the long-term sources are used to fund the current assets. This exactly the working capital funded by the shareholders' funds or working capital loans. That's good because the money has come from out. Profits that are retained in the business. When the profit is not taken for any other purpose, whereas it is invested in inventories of debtors, then the working capital position will be improved. What happens is out of the profits, which will be retained profit. Retained profit eventually can be invested in working capital. So the working capital position will be improved as such. If the customer feels that or investors feel that working capital should be funded only from capital rather than the debt. So that is a good thing. Good thing in the sense additional working capital is coming as equity. So the working capital position will be improved. The next point is not that good, but the working capital position will be improved as a result of that. That means conversion of short-term debts into long-term debts. That means short-term debts are like even the overdraft facility, which is stuck. It doesn't move. So some banks, of course, some customers request the banks to convert that overdraft into a term loan. When the overdraft converted into a term loan, the overdraft amount is taken away and it go and parked in debts. So the working capital will be improved. But that is not a good indication, by the way, because frankly, there is a liquidity issue. But this conversion will help the liquidity issue. Working capital deteriorate as a result of losses in the sense hardly any cashes. When a company make losses, the return profit will not be there, so that the money which should have been invested in stocks or the debtors are not there. So the working capital position, gross working capital position shrinks. Repayment of long-term debt, short-term funds. Now, eventually, if there is a overdraft facility, overdraft limit is marked, and if there is a room in it on the due date, if the loan repayment of a loan is connected to the overdraft, automatically it's get settled from the overdraft. Overdraft amount increases, the long-term loan amount get decreases. So as a result of that, what happens is working capital position decreases. Conversion of short-term debts funds for long-term uses. If someone is buying machines from working capital finance, someone is building a house or building a building or buy a land from TOD, sometimes it has happened. I have many cases, but I can't discuss with you over an online session. I can bring you, you can understand none of the cases are bringing here because I am so scared, not only myself, every lecturer is scared of bringing some of the case studies because it is online, anybody can access this one. So this is not the way of lecturing even. And dividend exceeding profits, of course, hardly any profit, but the money has taken away from the cash position, so that the money should have been invested in working capital deteriorates. That's not a good sign at all. So this is basically the value addition takes place. I could have shown you another way even. Let me show you the other way. Let's say that company requires raw material. So it's slicing the stores for a period of time until that is being pushed to the production. So certain amount of raw material is being pushed to the production flow, within which of course value addition takes place, but not 100%, probably 50%. As bankers, we go by 50%. If the customer allows us to access their ERP systems, so then we will know exactly what is the amount of money that is stuck in work in progress. But otherwise, what we do is we take 50% off. What this 50% comprises? Probably labor, direct labor, power, and the overhead expenses. When you say overhead expenses, the expenses are related to the factory premises, factory operations, various types of overhead expenses. And while it is in there, of course, here it is again, you can say raw material, but in this case it goes as WIP, work in progress. Now once it is finished, that's pushed to the another stores, and part of raw material and value addition 100%. That is called finished goods. Okay. Then further, which is sold on cash basis, nothing will be there, so that the entire amount will be converted into cash. That cash is equivalent to part of raw material, 100% value addition plus the margin. But so you can say it is cash. Otherwise, debtors. So this process you call that value addition, value creation problem. Now it takes time. So there are values attached to this process and also time taken during this, let's say that time taken, days stocks, days WIP, days finished goods, and days debtors. So there is a kind of a line over there which takes time. And in this event, you can see the value addition taken place. So apart from the raw material requirement, the company might require another expenses to add value. That also happens. Give me a second. Sorry about that. Hope that you could understand the value creation process. And there are two things happen. One is the value addition, and this time taken. Okay. And with that, now this is exactly what is happening in a cycle. You start with cash, buy raw materials, and it goes to working capital, work in progress. And you can see the value addition takes place. The raw material can be purchased on credit basis, accounts payable, and thereafter it converted into finished goods and sales, cash or credit. If it is credit, it goes to account receivable, received cash. Otherwise, from sales, of course, directly you can receive cash as well. At this point it takes value, and even at each point, like even this during the process of sales even takes VAT values, because the sales and distribution expenses are added on. Once it is gone into the receivables also, there is a value addition, because on credit basis they might charge certain additional expenses even to cover it up. Okay, so you can say it is operating cycle as well as a cash cycle, both are together here. Permanent or regular working capital, which I have already discussed. Permanent Working capital is the minimum level of current assets which continuously required by a firm carrying out its businesses activities and that cannot be converted into cash or normal course of business. Permanent working capital is either constant or it increases with the size of the business or scale of the operations. I told you how to exactly know the working capital. Permanent working capital is that every day you have to take, each and every day, take current assets minus current liabilities. Then there is a minimum requirement of working capital. That is the permanent level of working capital. Minimum requirement has to be there across the board. Some can say it is a buffer level. Buffer stocks as well as buffer debtors. The debtors are even not converted into cash 100%. It is a cycle, by the way, but within the cycle that you find there's a minimum level of requirement which has to be static. But this can be further increased provided the sales volume are going to be increased. Because see that, let's say the number of days, 60 days. Okay, that is the company policy. Right at this moment, the sales are only, let's say, 200,000. 200,000 divided by 365. They give only for 30 days. Right now, the working capital requirement for debtors is 16,438. Write it down. 16,438. Now, this is at the level of 200,000 volume of sales. Next year, it is going to be increased up to 300,000. 50% increase of sales. Now we see 300,000 divided by 365. But still the company policy is 30 days. So that 30 days, 24,657. Now the new working capital requirement for debtors, 24,657 minus 16,438. There's an incremental of 8,213, 8,219 rather. This is the additional working capital requirement simply because of the level of operations. So that is what is called. Permanent working capital requirement is either constant or it increases with the size of the business or its scale of operations. Characteristics. Continuity exists for a longer period of time in the business activities. That's basically what we assume this is 1 year. After 1 year, it should go more than that. There are 3 cases which can happen. One is it can be either increased. If the volume of sales is increased like 300,000 in my case, if the volume of sales going to be flat like another next year also 200,000, then you don't have to increase it. But the other scenario is if the volume of sale is going to be decreased, the permanent working capital requirement also going to be decreased. Let's for an example, 200,000 is going to be decreased up to 150,000. Now it is 150,000 divided by 365 into 30 days. Now the requirement is 12,328. Earlier it was 16,438. Now it is 12,328. So there is a decrease of 4,110, which should have been recovered either by the bank or the customer. Okay, this is not a good signal. Of course, this is what you need to review. When the working capital facilities are structured, what we say is maximum period is 1 year. Every year that you have to review and renew. Some banks, of course, structure the working capital facilities for 3 years, but subject to a very clear condition. The condition is that every year it has to be reviewed and renewed. You can't just renew it unless you review it. It is almost like a license, no? You know that car license are reviewed by the what do you call this? Dun sahathike කියලා කියන්නේ. Dun sahathike ගත්තේ නැත්නම් ආපහු license එක ගන්න බෑ. That is dun sahathike කියන්නේ review කරනවා. ආයෙත් license එක දෙනවා කියන්නේ renew කරනවා. So the same thing is applied here also. Constantly changes in the business from one asset to the another. You know the cycle grows the size of the volume business operations. That is understood. Temporary or revolving or variable working capital. I showed you within a corridor it varies. And any amount over and above the permanent work level of working capital is temporary working capital. It keeps on fluctuating from time to time as for the changes in production and sales. Sometimes it goes down, sometimes it increases, but there is a maximum level, there is a minimum level. It is an extra working capital needed to changing production and sales activities. It is created to meet liquidity requirements. It fluctuates according to the level of operations. So this is exactly the working capital requirement that I discussed with you. But what you need to look at is order goods. In the sense, let's go by the LCs. When you open an LC, From the day that you LC, of course, there's time taken to reach the goods to the site of the operations. So that time is called as lead time. Basically, from the day that they ship, and you can take the order level as well, order date as well. But that is a full-time lead time. But then again, for working capital requirement calculation, that we will take the bill of lading date from the other end. How many days that requires to reach the goods here in Sri Lanka? Okay, so the goods arrive here. Either you pay cash or supply credit. You get supply credit, and the stocks holding period is there, and that will be converted into manufacturing goods, and the goods will be sold either on credit basis or cash basis. Then if it is sold on credit basis, of course, that will be converted as debtors. Then you can collect cash from the debtors, then continue the same cycle. What you need to understand in this is how you map products. Okay, how you map products. You can see on the diagram, LC is one instrument. This is just an instrument only. Either STL or trust receipt or import loan or whatever you call for the conversion of the LC. And then once it is converted into sales good in the sense at that point, a very important document is created that is called commercial invoice. Once the commercial invoice is created, ideally either you can use bill discounting, bill factoring, or bill purchases, bill negotiation in export proceeds, export packing creditor. So all these products are available. Okay, what you need to understand is how the working capital operating cycle works, or the working capital cycle, cash cycle works, operating cycle or the cash cycle works. Working capital lending. Now we come to the last point, which is the most important one. So first we have to look at the purpose: permanent or circulating working capital. That is permanent or revolving working capital. If it is revolving, you need to decide whether it is cash, credit or overdraft. So amount, of course, you have to decide exactly working capital requirement or net working assets, average stocks plus average debtors plus minus average creditors minus accruers. Oh, now new word has come in here, accruers. What are accruers? You know, every organization, they are supposed to make the payments to the salary employees just after the month. In our case, of course, we are very comfortable before the month we get our salaries. Sorry. But that is not the case of many of the organizations. They don't pay. They will pay only after the month. Until such time, the money which should have been paid as salaries are invested in the stocks. So if you can get that amount into consideration, of course, that is also should be subtracted. So there are two things happening over here. One is the amount, the other one is the tenor. Tenor, of course, dates stock holding, days debtors holding, and minus days creditors holding period. How does it get repaid? So it's a successful completion of successive transaction of turnover and cash flow. So whether it is cash, credit or overdraft, there are cycles in it, of course. So you purchase goods, manufacture it, sell it, and get cash. It is one cycle. Likewise, there are so many number of cycles within which. So that is the crucial thing that we need to understand, how to determine exactly the cycle. That is why I told you, if the cycle is so long, the bank should be able to understand the cycle. So that is why the cash credit facilities are determined, or rather focused. If the bank cannot understand the cycle, because the company is so efficient, below 30 days. Okay, if you could remember the Nestle that I worked with you, 7 days. How do you understand the cycles? Very efficient, so that you can only provide an overdraft facility. Only you can provide an overdraft facility. But for Odell, the cycle is so long. I can't remember the days, of course, maybe about 80 days. So better you give them each cycle like 70 or 100 days or 120 days, whatever it is. Okay. Beware of lending too much, lending too little. Let me explain you one of the cases that I'm going to discuss tomorrow. Bank has failed to exactly determine the working capital requirement. You know what happened? So ultimately, the customer is so strong. He's a good one. He has an order. For the order, there's a working capital requirement. I'll tell you some hypothetical numbers. There's a working capital requirement of, let's say, 500 million. This customer doesn't provide the information. And the 500 million is the actual requirement. So the bank did calculate the working capital requirement based on the given information. The given information now underestimated. Why? He doesn't want to declare the information. He thinks the bank give it away to Inland Revenue Department for tax purpose. So he underestimate the numbers. So based on the given numbers, when you work out the working capital requirement, it comes to about 200 million. Now there's a shortfall of 300 million. You know what does the customer has done? He has borrowed from the money lenders. What is the rate? It's more than 3.5% per month. It comes to about 42%. Whereas the same could have been borrowed from the bank, say maximum 12%. 12%. See the difference? More than 30%. So now then you look at the margin of this one. Margin is about 25%, maximum, let's say 25%. Out of 25%, he has to make a percentage of 30% to the money lenders. So then what happens? Without his consent, gradually the business goes down. Now this is a crisis which happens everywhere. The reason is the entrepreneur doesn't understand the gravity of borrowing money at a very high rate of interest. Because ultimately, whether he likes it or not, of course, that quantum of percentage has been captured into the product, the entire business margin. Margin is not there, obviously. Margin is almost eroded by the excessive amount of interest rates. But what his argument is, no, I have borrowed only for a shorter period of time, let's say 6 months. Still, you take couple of cycles of which what happens finally, gradually, without your knowledge, you go out of the business. You go out of the business. It may be one order. Now, once he accommodate you from the money lenders, he will keep on borrowing from the money lenders and rather than coming to the bank. The beauty of money lender is that the moment you go there and they will lend you because he is a trustworthy customer. He's a very healthy customer until he goes on like this, of course. But there is a day he goes out. Now, who is the culprit for this particular exercise? Both parties. Who should have taken more action? The bank should have taken more action. Remember that fundamentally the customers are not giving information. Most of the mid-sized market customers are not willing to give you information. Then you might ask, so the same answer came up from my people also. Customer doesn't give us information. How can we work out? If the customer, then you should know there is a fundamental that the customer doesn't give you information. Then there should be a way of extracting the documents or other numbers from the customer. So you have to show him the working capital calculation and the gravity of borrowing money from the money lenders. Then he will agree. Then he will agree and give you. Otherwise, we have to craft the numbers. We have to craft the numbers. You, without asking financial statement, better you ask the order basis. How many orders that you did? Just let us know the order numbers, order information. Based on that, you can work out the annual working capital requirement, annual sales, annual cost of sales. And then you can work out for the next year as well. So this kind of insight, tracking information, and the intellectual capacity of credit officers, like an entrepreneur, should be there to help the customer. Don't blame the customer. Customers are not that educated in certain instances because that is what they know exactly and that is what they have been practicing. They believe that is the best practice that they apply because they are very they are entrepreneurs and they are successfully develop their business in certain cases. But unfortunately, without their knowledge, because of the weaknesses of the bank, they go into trouble. Most of the people get blackmailed when the banker is not helping with the purpose, objectively, I would say. Okay, so it is whether too little and too much, both are very, very crucial. Dangers of lending too much. Obviously, people ask for money. Sometimes if you don't know exactly what is the working capital requirement, if you fund them excessively, diversion of funds. Let me give you an example. Now, one of our customers had borrowed money for importation of raw materials and manufacture and sale. So he imports certain good and for stock working capital, work in progress and finished goods. Bank has given STL plus the debtors also continuous STL for, let's say, for hypothetically 180 days. Let's assume the production, raw material, work in progress and finished goods require only 90 days. Debtors 60 days. Okay, altogether 150 days. Now, ideally, you should give 90 days STL, 60 days bill discounting. After 90th day, the customer raise an invoice. That invoice can be discounted, and with that process, of course, you can settle the STL. So, no more STL, but there will be bill discounting. And the bill discounted bill has to be credited with the proceeds of the buyer. What happened was, continuously we had extended the STL up to 150 days. While the STL remains outstanding, the customer raise an invoice. That invoice can be factored or discounted from somewhere else. Then what happens? Double financing. So you allow the customer to get double financing. So that is not a discipline at all. So then what happened was, he kept on doing this exercise. He knew there is an excess money coming from with double financing. With that, he did not divert, of course. He bought another machine. To double the capacity of the operations. But unfortunately, because of for the bank, this machine did not work properly. Now the money which should have been invested in working capital has been taken to the purchase of machine. Now the machine doesn't work, no double operation, the same level of operations without sufficient working capital. The bank has done it, but unfortunately, he has diverted money out of the operations. This is what happens. Finally, unnecessarily, the bank exposure has been risen, and finally the customer went into trouble. Dangers, you can see, I am not going to explain each and every one. Focus on analysis, management ability to continuously do the operations, okay, and liquidity, marketability, because during this process, of course, the stocks might be propped up, but then again, you need to check the quality of the stocks and the finished goods. If they are not being able to sell in the market as projected, of course, what happens? The expected cash flows will not be coming to recover the advances that we have given away. So the bank officers should then and there should be able to check, and also you have to check the stocks and the debtors level, quality of the stocks. And by the time, if you are not supporting the customer, what happens is that they go and borrow from somebody else. And for which purpose, continuously you have to take the CRIB report and check. From the CRIB report, you can check the formal borrowings, but unfortunately, remember, excessive amount of formal borrowings will lead to another level that is called the informal borrowing. You will never know what the level of informal borrowing, but there are signals. There are signals to prevent, which I will discuss on the NPL management. With the signal, you should be able to track the fellow and try to go into the details and see exactly how best that he can help him to get away from the problem. So the relationship management is very important in working capital financing. Over trading is something that there is no clear definition. Obviously, over trading is something that you have an ego to make sales, for which purpose you might borrow money and accumulate a lot of stocks. When the stocks are not being sold, what happens is that forcibly sell them on credit basis. When the creditors don't settle the money, of course, they give them discounts and various other profitable proposals. And finally, what happens? You buy at 100, sell at 60. So you make a loss. It continuously happens, and finally, it is the closure of the business. This is so serious. This is so serious. Assessment of working capital. Now we come back to the numbers again. Working capital requirement. So in every case, remember, you need to calculate the working capital requirement, definitely. No way. And thereafter, you have to extract the facilities provided by the bank plus the facilities provided by the other banks. Okay. Facilities provided by your bank, facilities provided by other banks. Then you have to subtract the balance sheet sources and balance sheet needers, in the sense long-term sources versus long-term users. That means the money that has been injected by the shareholder, in short. the money that has been invested by the shareholder. Then you will get the funding requirement. Based on the funding requirement, you can facilitate. Now this slide is so important. Setting limits. Basically, the banks are setting periodic limits. When you set the periodic limits, what you need to do is take the annual requirement divided by 365, then you get the daily requirement into time outstanding. Even if it is an LC limit, the same thing, but different formations are created based on the time outstanding. You can create it the way that you want, of course. So we will do a couple of examples, then you will understand. Whether it is bill discounting, import loan, or whatever it is. So I will do a kind of example, then we will try to understand. So far, any questions? Now we'll go to the case study, and it says suggest a credit facility. So I say credit facility was suggested. The next question is, if the customer imports materials under documentary credit site where the lead time is 30 days, rework the credit package. So you need to understand this equation. Now you have additional thing, LC. Then you have the stocks. Of course, this is the order. And debtors. So LC, it says lead time is 30 days. Stocks, 30 days. And debtors, how much? 31.5 days. Okay. Did I work out the facility that they requested earlier on? Can't remember. Did I answer the first question, please? Suggest a credit package. Did I do that?
Yes, sir.
Okay. Now, if everything is going to be imported, you don't talk about the creditors now. So creditors are not there. Okay. This will not come. Now I am going to try develop a LC limit. So LC requirement is totally 110.76 divided by 365 and go to the lead time 30 days. So LC limit 110.76 divided by 365 into 30 days, 9.10. STL as usual, 9.10. Then for debtors, ideally you should go for a bill discounting, 9.55. So LC limit for 30 days, STL for 45 days, and bill discounting for STL for 30 days, bill discounting for 45 days. Altogether, exposure is 27.75 million is the total exposure. 27.75 million is the total exposure. So LC limit is 9.10 for 30 days, STL limit is 9.10 for 30 days, bill discount is 9.55 for 45 days. But remember, these are separate limits. So there will be a problem with the customer. The customer might ask you, no, I need more LC because it is not practical. Sometimes when they bring down the materials, they come in containers, various problems are there. So you better give him a separate limit concept. What is separate limit? In this case, I will take LC limit 110.76 divided by 365. I will take 30 days LCs plus 30 days debtors plus 31.5 days of 30 days LC lead time, 30 days stock retention period, and 21.5 days worth of debtors period. So altogether 91.5. So 110.76 divided by 365 into 91.5, which comes to about 727.76. Now the LC limit is 27.75, and these limits are going to be sublimits. Still, the total exposure is 27.75. So these are the most practical ways of structuring a customer with LCs and STLs and bill discounting. At any given point, the total exposure is 27.75, which means either he can have all LCs of 27.75, or the combination of these things are subject to a maximum limit of 27.75. The dates are given, and then you can structure the securities. Most probably for this one, you will ask for the title of the documents or the title of the goods, because the consignee is the bank, and plus some cash margin and indemnity to the company. But in this case, you may need collateral. Bill discounting, you have the bills. So that is how you structure the facility. So bill discounting is more strong than the STL because it is converted into sales. It is just a matter of getting proceeds from the buyer. Any questions so far? Huh? Are there any questions? Hello. No questions? I also forgot to tell you how to structure a facility without an LC. I think I didn't discuss. Now here, assuming there are creditors over here, then you have to structure a STL facility. What is the amount of the STL then? STL. Is it 9.10? 30 days? No, that you get a comfort of 3.64 million. Then 9.10 minus 3.64. STL limits come to 5.46. Bill discounting? Yeah, 9.55. So you get same amount, 15.01, 15.01. There's another way of calculating the 5.46. That means 18 days. The whole requirement annually 110.76 divided by 365 into, you get 30 days minus 12 days. That means 18 days. You will get the same answer. So now you should be able to understand why I am not taking sales as debtors. If I took sales, I can't show you the reconciliation. Now you can do it and you can take sales and do the favor of the customer. I don't have any issue. But I wanted very specifically to understand how to technically structure facilities. But then knowing the technicality, that is the science, you can go into commerce. That based on the customer's discussions. Any questions? That is only for today. That's it for today. I have no energy to drive the whole session because no responses coming from you. Any questions so far? There's another case study. The third case study is quite comprehensive. I'll do it with you in the next week. Any questions? Nadda? No? Okay, thank you very much for joining and also wish you all the best for the new year. And probably we don't have a vacation for the next Sunday even. So I'll be meeting up with you. Thank you.